All right, today we are going to do something that might sound a little intimidating. We're going to tear down a corporate financial report. Now, I know, they can look like a monster of numbers, but I promise they're not. We're going to demystify one together, and we're using the latest report from Eicher Motors, yep, the folks who make Royal Enfield bikes, as our guide. So let's just dive right in.
Okay, so you open one of these up, and wow, at first glance, it is just a wall of text, a sea of tables and jargon. It's designed to be super precise, not exactly user-friendly. It's so easy to look at this and just think, nope, not for me. But hang on, stick with me, because hidden inside all these tables is a really fascinating story.
You should really think of this document as a company's quarterly report card. It tells you exactly how they did, where their money came from, where it all went, and, the big one, whether they're actually winning. So our mission today is to learn how to read this report card and uncover the real story behind Eicher Motors' performance.
And don't worry, we've got a clear roadmap. We'll start with the basics, then we'll hit those big headline numbers. After that, we'll see how the profit is actually calculated, understand a really crucial difference between two types of reports, and then the fun part. We'll go hunting for clues in the fine print. Let's get to it.
All right, section 1. So before we even get into the specific numbers, let's just set the stage. Our goal here isn't just to read numbers off a page, right? It's to understand the story, the narrative they're building about the company's health and its strategy.
Every good story starts with a great headline. And believe it or not, financial reports are exactly the same. You don't have to read every single line to get the main idea. We're going to jump straight to the two most important numbers first, revenue and profit.
First up, revenue. For this quarter, Eicher Motors brought in over 6,100 crore rupees. Think of this as the top line. It's the total amount of money they made from selling motorcycles and commercial vehicles before any costs are taken out. It is the starting point for absolutely everything. And next up, we have net profit. So after paying for literally everything, the materials, the salaries, the taxes, you name it, Eicher was left with over 1,400 crore rupees. This right here is the famous bottom line, and it's probably the clearest signal of how profitable a company is. But is that number actually good, or is it bad? See, context is everything.
And boom, this is where the story really comes to life. When you compare this quarter's profit to the very same quarter last year, you see a really healthy jump. They went from about 1,170 crores to over 1,420 crores. Now that is a strong sign of growth, and it's exactly the kind of headline that investors love to see.
So we know the headline. Profit is way up. Awesome. But how did they get there? Let's peel back the onion a little bit and look at the simple math that gets us from that huge revenue number all the way down to that final profit. At its heart, business is actually incredibly simple. It all comes down to this one formula. You take all the money that came in the door, you subtract all the money that went out the door, and whatever's left over, well, that's your profit, before you pay your taxes.
And here are the actual numbers for Eicher Motors. See, their total income was about 6,451 crores. Then they spent around 4,785 crores just running the business. That left them with a profit of almost 1,800 crores before taxes. But what exactly are those expenses? Where did all that money go? Now, this is where it gets really interesting. A massive 67%, that's almost 3,200 crore rupees, went into raw materials and components. That's the steel, the rubber, the electronics for their bikes and trucks. For a manufacturer like Eicher, this just shows you that managing their supply chains and what they pay for materials is absolutely critical to their bottom line. Okay, this next part is super important for understanding pretty much any large company. When you open a report, you'll often see two different sets of results, standalone and consolidated. They tell slightly different stories, so let's break down exactly what they mean. So, standalone is pretty simple. It's just the parent company. In this case, Eicher Motors Limited itself. But consolidated, that's the big picture. It rolls up the numbers from the parent company and all the other companies it controls or has a big stake in. Think of it like its international divisions or its joint ventures. For a global company, the consolidated view is almost always the most meaningful one to look at. And you can see the difference clear as day right here. The standalone parent company made a profit of about 1,290 crores, but the consolidated group, the whole family, made 1,420 crores. That gap, that difference, comes from the profits of all those other companies in the Eicher group. So who's in that family anyway? Well, the group includes a whole network of companies. You've got Royal Enfield's divisions in North America and Thailand, plus this huge joint venture called VE Commercial Vehicles, which then has its own subsidiaries. This global structure is exactly why those consolidated numbers tell a much, much more complete story. We've covered the big numbers, but honestly, the real detective work is in the fine print. Let's go digging and see what crucial context and interesting little details are hidden away in the notes at the end of the report. This is a pretty fundamental question. How do we even know these numbers are real? Well, that's where the auditors come in. They're an independent accounting firm, in this case S.R. Batleboy & Co., and their job is to review the company's financials to make sure they're fair and accurate. You can think of them as the referee. This is the key phrase from their review report. I know, it sounds kind of like a weird double negative, but in the world of accounting, this is a clean bill of health. It's basically the auditors saying, hey, we checked their homework and we didn't find any major errors. This is what gives investors confidence in the numbers. Now, as you're digging through a report, you might come across something called an exceptional item. This is basically a flag for a big, one-off event that's not part of the company's normal day-to-day business. Whenever you see one, it is always worth investigating. And look what we found in Note 6 of Eicher's report, an exceptional item. It's a one-time charge of over 55 crores. And the note explains that it's because of new labor laws passed by the government. This is a perfect example of a story that was hidden in the notes. It tells you about a real-world event that had a significant, one-time financial impact on the company. So let's just tie this all together. After looking at the headlines, doing the math, and digging through the fine print, the story becomes crystal clear. Eicher Motors had a very successful quarter. They brought in strong revenue, and they grew their profits significantly compared to last year, even after we account for that one-off expense.
And that's really our whole goal here, to show you that these reports are not some impenetrable documents meant only for accountants. They are just really detailed stories about a company's journey. And once you know the structure and where to look for the good stuff, they open right up.
So we'll leave you with this thought. Every single public company has a report card just like this one, telling its own unique story every 3 months. Now that you've got the tools to read one,
You know that feeling when you walk into a crowded room and just all at once everyone stops talking, that heavy sort of loaded silence where you just know something is about to happen?
That is a very specific kind of tension.
Yeah.
The calm before the storm.
Exactly. And looking at the technical chart we have for today, that is precisely the vibe I'm getting. We're looking at Eicher Motors, that's ticker Eichermot on the NSE.
Right.
And for anyone who follows this stock, you know it's usually a mover. It's got personality. But this snapshot we're analyzing from late October 2025 all the way through to today, February 10th, 2026, it tells a story that ends in this very, very suspicious silence.
Suspicious is the perfect word.
Yeah.
I mean, what we're looking at here is a daily chart sourced from Nuvama. You can see the watermark. And it really captures a complete emotional cycle.
Oh, complete cycle.
We went from, the depths of despair in November to absolute euphoria in January. And now we're in the waiting room.
So let's unpack this properly. We aren't just reading numbers today. We're trying to get inside the heads of the people actually trading this thing. When I look at the big picture here, the market structure looks confused. Or maybe conflicted is a better word.
Conflicted is a great way to put it. You have to remember, a chart like this isn't just lines on a screen. It's a battle map.
Right.
It shows where the bulls, the buyers dug in their heels, and where the bears, the sellers, just swarmed the field. And right now, if you look at the far right side of the chart, the battle lines are drawn very, very tightly.
Before we get to that stalemate we're in today, we have to talk about how we got here, because you can't understand the silence of February without understanding the noise of December.
That's so true.
Let's rewind to the left side of the chart. Late October, early November 2025, it's ugly.
It was a textbook capitulation phase.
Yeah.
I mean, if you trace the price action from the far left, you see that choppy, just grinding downward trend. But look at mid-November.
Oh, yeah.
That cluster of red candles dropping straight down, that's what we call a flush.
That's the puke point, right? Where everyone who was holding on just finally gives up and sells.
Precisely. Look at the y-axis. The price got hammered down into that 6,500 to 6,600 zone. Psychologically, that is a brutal place to be if you're holding the stock.
You're just seeing red every single day.
Every day. And the fear is palpable. You're thinking, how low can it go? Is it going to 6,000?
But that's the thing about market psychology. Maximum fear usually marks the bottom. And sure enough, right there in mid-November, the bleeding just stops. It's almost like someone drew a line in the sand at 6,600.
That is exactly what happened. We call that a demand zone. The institutional money, the so-called smart money, they saw that 6,600 price tag and said, okay, this is cheap.
And you can see the shift immediately.
Immediately. The candles stopped being red and start turning green. The selling pressure just evaporated because, well, there were no sellers left.
And then the rocket took off. I mean, look at late November through December. That is a V-shaped recovery if I've ever seen one. It's not just a slow drift upwards. It's an aggressive march.
That's the markup phase. And what's fascinating here is the speed. The stock didn't spend any time building a base. It just turned around and sprinted.
Wow.
It ripped through 6,800, smashed through 7,000. Any short sellers who were betting on the price going lower in November got absolutely squeezed here.
That's the pain of the short squeeze, right? They have to buy to cover their losses, which just adds fuel to the fire and pushes the price up even more.
Yep. And that brings us to the peak, late December 2025, into that first week of January 2026. We're hovering way up there, well above 7,500.
The euphoria phase.
Exactly. This is where the retail money usually chases the move. The news is good, the chart looks like it's going to the moon, and everyone wants a piece of Eicher Motors.
But 7,500 is a big, round number, and those psychological resistance levels, they're real. It looks like the air got very thin up there.
It did. You can see the candles getting smaller, they're struggling to push higher. That represents exhaustion. The buyers are running out of ammo. And once that momentum stalled, the profit-taking began.
Which leads to the hangover. January was rough. We see those large red candles in late January. They're violent rejections.
Oh, yeah.
We tumbled from that 7,500 high all the way back down towards 7,000.
That is the reality check.
Right.
But, and this is crucial, we didn't crash back to the November lows. We pulled back, yes, but we established a higher low.
Ah, okay.
So the structure of the uptrend is technically still intact, even though January felt terrible.
Which brings us to the present moment. February. The dust has settled. We're not crashing, but we're certainly not rallying either. And this is where the technical indicators, those overlays on the chart, start screaming at us.
They really do.
Let's talk about those green bands, the ones acting as a channel for the price, the Bollinger Bands.
This is one of the most important features on this chart right now. Bollinger Bands measure volatility. When the market is wild, the bands widen out. When it's quiet, they contract.
And look at what's happening right now in February.
They're squeezing.
I mean, really pinching in. The top green line and the bottom green line are getting closer and closer together.
We call that the Bollinger Squeeze. And in technical analysis, this is a massive signal. It tells us that volatility has collapsed to historically low levels for this time frame.
But low volatility doesn't last forever, does it? It's like compressing a spring. You push it down, it sits there, and it's just storing potential energy.
Exactly. The market cycles between periods of contraction and expansion. Right now, we're in deep contraction. The price is being compressed. This usually precedes a really violent move.
So the longer the squeeze,
The more explosive the breakout.
Yeah.
The breakdown.
So the market is basically just holding its breath. And look at where the price is sitting, right up against that red line in the middle of the bands. That's the 20-day moving average, isn't it?
Correct. The 20-day simple moving average, it acts as the mean and the center of gravity.
And the price is glued to it. It's just tangling right around that red line.
That is mean reversion in action. Back in December, at the peak, the price was way above the red line, pushing that upper green band. It was overextended.
Yeah.
Now, it's come home. It represents fair value for the last month of trading. The market agrees that, for right now, this is the price.
But the market never agrees for long. So let's look for some confirmation for this indecision. I'm looking at the middle panel, the RSI, or Relative Strength Index. This is usually my go-to for seeing if something is overbought or oversold. But looking at this purple line, well, it's boring.
Boring is significant, though. Look at the value. The RSI is oscillating right around the 50 mark. You can see that horizontal midline on the graph, and the Popo line is just weaving right through it.
And 50 is the definition of neutral.
It's the coin flip zone. If the RSI is up at 70, the bulls are in charge, but maybe they're overextended. If it's down at 30, the bears are in charge, but maybe they're exhausted. At 50, it's a tug of war. Both sides are pulling with equal strength. Nobody has the edge.
It's interesting because sometimes people look at an RSI of 50 and just think noise. But in the context of that Bollinger Squeeze we just talked about, this RSI reading feels more like a reset.
That's a great observation.
The momentum has completely neutralized.
It is a reset. The overbought conditions of January are gone. The oversold conditions of November are a distant memory. The slate is wiped clean.
And that means?
It means the next move, whichever direction it takes, will have fresh momentum behind it. It won't be fighting an overextended indicator.
Okay, now I want to pivot to the volume, because that's usually where the truth hides. We're looking at the bottom panel. And honestly, the current volume here in February, it looks pretty anemic. The bars are tiny.
They are very low. But before we analyze the low volume, look back at late December. Do you see that one massive bar?
Oh, you can't miss it. It's a skyscraper compared to everything else. It stands out like a sore thumb right in the middle of that rally.
That is a critical piece of the puzzle. That volume spike happened during the ascent. That tells us that the moves up to 7,500 wasn't just retail traders having fun.
No.
That was institutional participation. Big money was changing hands. That level of volume creates a kind of memory in the market.
So fast forward to today. We've dropped from the highs, but the volume on this pullback in late January and February is just, it's drying up.
Yeah.
What does that tell you?
In what we call volume price analysis, or VPA, this is generally a constructive sign. If the price was dropping on massive volume, it would mean everyone is rushing for the exits panic selling.
Right.
But here, the price drifted down and the volume disappeared. It suggests there's no heavy selling pressure. The sellers aren't aggressive, they're just done.
So the sellers are tired, but the buyers are hesitant. That explains the low volume stalemate. Everyone's just waiting for a catalyst.
Precisely. The smart money often steps aside during these consolidation phases. They don't want to get chopped up in a sideways market. They're waiting for the chart to tip its hand.
Which brings us to the star of the show, or at least the most recent data point. Today's candle, February 10th, 2026. We have the raw numbers in the top left corner. Let's dissect this single day of trading because it's a microcosm of everything we just discussed.
Okay, let's break it down.
Okay, we've got open, 7280.000, high, 7325.00, low, 7201.000, and the close, 7296.00.
Those numbers paint a very specific picture. Start with the low, 7201.
That stood out to me immediately. 7201, that's a dangerously specific number. It's just one tick above 7,200.
Exactly. 7,200 is a big psychological round number. There were likely a ton of stop-loss orders sitting just below 7,200. The bears tried to push the price down to trigger those stops, to flush the market.
The liquidity grab.
Yes. They pushed it to 7,201, practically testing the water, but what happened? The price didn't break. Buyers stepped in aggressively right at that level to defend 7,200.
So that lower wick on the candle tells us there's demand sitting right there at 7,200. The bears poked the hornet's nest and got stung.
Correct. Now look at the high, 7,327. The bulls tried to rally. They pushed it up, but they couldn't sustain it either. They got slapped back down.
And we closed at 7,296. We opened at 7,280, so we finished the day, 16 rupees higher?
Which is statistically irrelevant on a stock priced over 7,000. It's a flat day.
Visually, this creates what? A spinning top? A doji? Something like that.
It's essentially a spinning top or maybe a high wave candle. It just signifies pure indecision. The market went down, it found buyers, went up, found sellers, and it decided to call it a draw, right in the middle.
And look at where that close is, 7,296. It's sitting perfectly inside that recent trading range. We have the labels on the y-axis. 7184 is the recent support, and 7503 is the resistance. We're smack in the middle of no man's land.
And to bring it back to our earlier point, 7296 is right on top of that red 20-day moving average. The magnet is still working. The price is refusing to leave the average.
So if I'm a trader looking at this chart, I'm seeing a coiled spring, I'm seeing a volatility squeeze, an RSI reset, and I'm seeing a daily candle that just says, I have no idea where to go next. This feels like a trap for anyone who's impatient.
It absolutely is. This is the chop zone. If you try to guess the direction right now, you're not trading, you're gambling. The probability is 50-50.
So what's the play? What are we watching for?
You watch the boundaries of the squeeze. You watch that 7,200 level we just talked about. If we see a daily close below 7,200, especially on high volume, that breaks the structure. That opens the door back down to the 6,800s.
And on the upside.
You need to see the price reclaim the recent high. Breaking 73,200 is a start, but really you want to see a clear 7,400 to confirm that the bulls are actually back in control and ready to challenge that 7,500 peak again.
It's interesting, isn't it? We often think of doing nothing as being passive. But in this case, the market doing nothing, consolidating, squeezing, is actually a very active process. It's building cause.
Building cause, that's a Wyckoffean term. And it fits perfectly here. The bigger the cause, the bigger the effect. The longer this stock goes sideways in this tight range, the more energy it accumulates for the eventual move.
And that energy has to go somewhere. It's physics.
It's market physics. When the breakout happens, it will likely be fast. And because the volume has been so low recently, people have been lulled to sleep. They aren't paying attention.
That's when the market likes to move the most, when no one is looking.
Exactly. And that is why this boring chart is actually incredibly exciting. It's setting up a tradable opportunity, but it demands patience.
So for you, the listener, staring at this snapshot of Eicher Motors, the takeaway isn't buy or sell, it's wait and watch.
It's prepare. Identify your levels. Know where you're wrong. If you're bullish, you need to know that below 7,200, your thesis is broken. If you're bearish, you need to know that above 7,400, you're in trouble. The chart is giving you the roadmap. You just have to wait for the car to start moving.
You know, it reminds me of that old saying, the market is a device for transferring money from the impatient to the patient. This chart feels like a masterclass in that concept.
It really is. The novice looks at today's candle and sees nothing happening. The pro looks at the squeeze, the RSI reset, and the volume profile and sees opportunity loading.
Before we wrap up, I want to touch on one final sort of philosophical point about this view. We spend so much time analyzing the history, the left side of the chart, the crash in November, the glory in December, but the hard edge of the chart, the right side, it's always a cliff.
The hard right edge is the unknown.
We can calculate the probabilities, we can look at the Bollinger Squeeze and say volatility is coming, but we can't say for certain which way it breaks.
And that's the humility the market forces on you. No indicator, no matter how sophisticated, not the RSI, not Bollinger Bands, not volume, can predict the future with 100% certainty. They only manage risk.
So here's a thought to leave you with as you go about your day. We look at charts to find answers. But when you see a stock hugging that middle line, resting at an RSI of 50, effectively doing nothing, ask yourself this. Is it resting because it's tired from the climb and about to faint? Or is it resting like a sprinter in the blocks, gathering oxygen for an even higher summit?
The history is written on the chart, but the next candle, that is always a mystery.
A mystery indeed. Thanks for taking this deep dive with us into the heartbeat and the silence of Eicher Motors.
My pleasure.
Keep your eyes on the levels, everyone. We'll see you in the next deep dive.